Nilesh Shah, Director with Access Direct, joins us live. Nilesh, good morning. Thank you for joining us. Nilesh, today it's all about the big adjustment in emerging market currencies, emerging market equities, and metal prices. But once the adjustment is over, what's next for us?
I think once the party is over, we'll have to go back to the basics. In some sense, Fed has given some amount of time for us to put our house in order. And this is a great opportunity. Rupee, at one point of time, people were talking about 70 and 75. Now it is back to 61, 62. At one point of time on equities, people had lost hope and faith. We are almost near to all-time high level, give and take few percentage points here and there. Interest rates were at 9.5% and threatening to go higher. We are almost at 8.17% and now threatening to go lower. So we have bought time to make our house in order in terms of revival of investment. The opportunity is there for us, and now what we do on revival of investment will determine how the markets will shape up over the next quarters to come.
Nilesh, does it seem like Raghuram Rajan is going to play along and appease the markets, as has been Bernanke's standpoint? He sure enough cannot cut rates, but do you think a status quo policy is something that is already priced in?
Definitely market is having lots of expectations from RBI, and the beauty is that he doesn't have to cut the rates. Even if he hikes repo rate and lowers the MSF rate, market will be probably more than happy to receive that. So clearly market has a lot of expectations from RBI. Fed has given the elbow room. RBI has taken various innovative steps which could be supportive of growth without putting pressure on inflation. The swap on foreign exchange deposits for banks, the talk about giving concessional financing for auto and housing loans. These are all steps which will be pro-growth but will not have impact on inflation, will not push up inflation. So clearly market is looking forward with eager breath to 20th tomorrow. What will governor announce?
Benchmark indices or Nifty is up about 12% from the recent low. In dollar terms, the appreciation is about 20%. Do you think, fundamentally speaking, we deserve to trade at 6,000?
From a Sensex point of view, probably yes, because it's too polarized towards technology companies which are benefiting from rupee depreciation and revival of US economy. It is also polarized towards consumer staple where valuations on the basis of lack of supply could be probably justified. It is now trading at this level on pharmaceutical companies which also are beneficiary of the rupee depreciation. So definitely from a fundamental point of view, Sensex at this level, driven by these sectors, is justifiable. What we have to worry about is that there is a whole host of sector across infrastructure, power, utility, real estate, banking, which is not participating in the rally. And there were concerns on currency, there were concerns on interest rates, there were concerns on inflation. Now you have a breathing space. If we can get back to revival of investment, then certainly people will be far more positive to India. Delhi looks far better from outside than probably from India. And if you remember last time when I was on television and markets was not in such a euphoric mood, we were saying that this is time to buy, even the prices will correct in the short term because it's a clearly value to buy. Now probably things have turned around in such a short tenure. Hopefully we have the breathing space, we have the time to correct our house in order, and we can sustain this rally. So from all point of view, yes, markets are at a fair value.
For those who missed a large part of this recovery stroke rally or technical adjustment, should they jump in now or they should wait for better entry points, and as the year unwinds, maybe prices could be better than what they are?
Markets are markets, they'll fluctuate, they'll go up and down. But if you haven't participated at all, then this is the time to buy. But buy very small amount because you know you are buying at 20,500 level of Sensex. You will have to keep space for buying if the price is correct going forward for some reason. But if you are already invested, then probably this is not the time to buy and you can afford to wait for prices to correct. Again, people will have to overcome this mentality of taking short-term call on the prices, because in the short term anything can happen. But now we have an environment, a macro, which is probably giving us opportunity to recorrect our house. Interest rates are on their way down, currency seems to be stable, and it has already corrected its overvaluation. You have pro-growth policies coming into play, and while there are concerns on what will be the election situation and so on and so forth, you at least have an opportunity whereby this rally can be sustained going forward.
Nilesh, so sectorally, since you track IT pretty closely, does IT still remain a long trade? And if someone's completely missed out on the rally, is it still a good time to buy into dips?
Definitely, we think technology today gives a great opportunity. The economic condition of the developed markets have revived, and even though Fed has withstand from tapering off, at least that gives the confidence that the economy is going to grow at 2% and 3% plus in next years. Second, the rupee depreciation has also given great benefit to this IT companies. Put these two things together, valuations are not exorbitant like consumer staple companies. So yes, technology is one sector which is a must-own in an individual's portfolio.
Technology has a 14-15% weightage on the Nifty. What should be an ideal exposure to IT?
If you are already invested, then probably, from a fund manager's point of view, it's probably worth having about 18 to 20% weightage in the technology companies. Within technology space, you have large cap companies as well as mid-tier companies. And a lot of the mid-tier companies are having free cash flow generation and are available at very, just around single-digit valuations. Clearly, that basket also provides great opportunity.
Let me remind you of a quote which you gave to us in April when Infosys cracked by 15% plus. You said, at 2200, I would be buying Infosys with both my hands. Infosys did go to 2200. I'm sure you must have bought Infosys at 2200. The point is, should one sell Infosys now or should one still hold on to Infosys?
No, I think it is still worth holding on. At that time, market gave you the opportunity of excess return in Infosys. Now, the company will give you normal return opportunity and it will still be outperformer over the market. The environment is in favor of the company. Company is taking corrective steps. Currency is in their favor. And the opportunity in developed market is also reasonably big. So you don't expect abnormal return from Infosys at this level because market did give that opportunity in last 1.5 years. And if people were smart enough, they would have captured it. But even today, it is not too late to continue to hold on to Infosys for market outperformance.
Nilesh, what about banks? Because the way they've been beaten down, not just PSUs, but some of the private banking names as well, last 2 months has been pretty alarming, underperforming the markets. Are valuations now looking ripe, at least on the private banking